You are welcome to my channel. This is Kevin Davis Accounting. So for today, I would like us to continue with our topic. Of course, we are still looking at goodwill, and I would like us to take a question, of course, and I know it will help you understand better the concept I was explaining. So this is the question. It says, Brian and Eunice have been in partnership for 5 years, sharing profits and losses equally. On 1st January, they decided to admit Robert. The statement of financial position of Brian and Eunice before admission of Robert is as follows. So they give us a statement of financial position as at 31st December 2018. So the non-current assets we have a non-current asset of 75,000. We have the current assets, we have inventories 40,000, receivables 25,000, cash 15,000, giving us a total of 80,000, and the total assets we have 155,000. Equity and liabilities, we have capitals from Brian, it is 80,000, from Eunice, it is 60,000, giving us a total of 140,000. Then we have the current liabilities. Now, the current liabilities, we have the creditors, which are payables of 15,000, giving us a total of 155,000. Then the following information is also relevant. Robert, as part of his admission, will provide a capital of 55,000 to the partnership. Then, goodwill, which has never existed in the books, is to be valued at Uganda shillings 50,000. The profit and sharing ratio after the admission of Robert is to be in the ratio of 4:2 for Brian, Eunice, and Robert respectively. You are required to show the following accounts. 1, we have the goodwill account, the partners capital account, and the statement of financial position after the admission of Robert. Then they are saying, note, solve the above question for 2 different scenarios. I, goodwill is to be maintained in the books. Goodwill is not to be maintained in the books. So that's the question that we are going to solve. And I believe by the time we are done with this question, you will be better off and you can solve a number when it comes to goodwill. So that told us that the first thing that they need, of course, they're supposed to open up a goodwill account. Now, I'm going to solve now one for the scenario where goodwill is maintained in the books. So we shall start with, of course, we shall draw up our, like this. We call this goodwill account. So this is our goodwill account. Now, in our goodwill account, remember I told you, of course, you're going to debit the capital account. So we shall come and we say we are debiting the capitals. And of course, we shall have Brian. So remember, if you go back in the question, they tell you that these people share, they share profit and losses equally. So if that sits, then that means Brian will have a half times, of course, now the goodwill, which was brought in by, this is it. So we shall get 25,000. And then we shall have Eunice, and so we shall have a half times 50, giving us still 25,000. So this is what we have, and then we shall balance off our figures. That means we shall have balance it off like this, and then we shall have 50, and then 50, and then we shall have our balance carried down as 50,000. So this is it. This is how our goodwill account is going to look. Now, firstly, this is where goodwill is to be maintained in the books. Then they told us they told us to draw up the capital accounts of the partners. So we come here and say, let me rub off this, and I draw up the capital accounts. So let me just do it down here. So we shall draw up here. Of course, we have here our capital accounts. So we shall have, we have Brian, we have Eunice, and we have Robert. Still the same thing. This side we have Brian, we have Eunice, and we have Robert. And of course, we're going to be doing in Ugandan shillings, Ugandan shillings, Ugandan shillings here, like this, and like this. So this is how it looks like. So we go back to the question. So we go back to the question. So this is how it looks like. So we go back to the question. And then in the question, we realize there was a balance brought forward. Of course, the balance brought forward. If you see in the statement of financial position, actually, the balance brought forward for Brian was 80,000, and that of Eunice was, if you take back the statement of financial position, is 60,000. So this is how we are going to record this. Of course, now here we can have details or particulars. Let me say particulars, and here I shall have our particulars. So this is how it looks like. So remember I told you that when it comes to the capital accounts now, capital accounts always increased on the debit side, on the credit side, sorry, on the credit side. And so sometimes we can also have a balance brought forward on the other side, but for this scenario, it is this. Now, from the question, I think you can realize that we are working on a fluctuating capital account. It's not a fixed capital account. So here there is no need for us to prepare a current account. So if you go back in the question now remember they told us to draw up a goodwill account and a capital account. Now we're already done with the what? The goodwill account. Now we have drawn up a capital account. Now after this, we are going to share now the goodwill. So we shall say goodwill. We bring our goodwill here. Our goodwill, how much did Brian receive? Brian received 25,000. From here you can see it. Then Eunice also received 25,000. So I think you can see how it is being done. So this is what these people shared when it came to goodwill. Then realize also Robert introduced certain amount of cash in the business. So they told us that Robert introduced cash as capital. So we come here and we say cash, which was being introduced, and it was how much? If you check back, the cash was worth 55,000. So you come here and say 55,000. So basically, this is all that we have in the question, or the question demands. This is all that we have. So what we are going to do, we are going to balance off our capital account. So what we're going to do, we shall say balance off this like this. No more balancing off. And here we shall still balance off. So we're going to go with the normal way of balancing off. So realize that this value of course is bigger. So you add this, you have 105,000. You get. So when you add this still, we shall have 85,000, and we shall have 55,000 here. I think you can see. So being that it's a heavier side, we shall bring the same amount here. Then we shall have 85,000, and we shall have 55. Therefore, our balance carried down will be 105,000. We shall have 85,000, and we shall have 55,000. And our balance brought down will be 105,000. 85,000 and 55,000. So we are done with our We are done with our capital account. So this is how our capital account is going to look like. So now this figure is the figure that we are going to take in the statement of financial position under the capital side. So remember I told you that when goodwill is being maintained in the books, of course when we are drawing up the statement of financial position, we shall indicate the goodwill. So basically this is it. I'm going to rub off this, then I'm going to draw up the statement of financial position for the partners. Let us draw up the statement of financial position. So we shall say statement of financial position as at 1st January 20. Remember, this was the date. This was the date when Robert was admitted to the what? The partnership. Therefore, of course, we shall have our Ugandan shillings here and our Ugandan shillings. So we shall begin with, of course, there was a net asset of the business, non-current asset, sorry, it was a non-current asset. So we had a non-current asset, and the non-current asset of the business was worth how much? If you check back in the question, it was 75,000. So you bring here, you say 75,000. So now this is not enough on the assets. Remember, we had goodwill, so we accounted for goodwill, and I told that goodwill is an asset. So we come here and we say goodwill, and our goodwill was worth 50,000, like you can see. So when we add this, the total, of course, we shall have this is the amount that we have. So when we add our current assets, our non-current assets plus the goodwill, then we had current assets in the business. We had current assets, so we shall come and say our current assets. So we had, if you check back in the question, we had inventories worth 40,000. So we come here and say inventories, they are worth 40,000. Yes, this one we had it in our statement of financial position. Then if you go back to the statement of financial position, we had receivables, and our receivables were worth 25,000. Then still in our statement of financial position, we had cash, but our cash was worth 15,000. But remember, when Robert was being admitted to the business, actually Robert came in with a certain amount of money. So Robert came in with how much? With 55,000. So that means you're going to add it as cash because we have it in that business. So we shall say it will be 15,000 that we had. Remember, then plus our 55,000. Now this 55,000 is the money that Robert introduced to the business. Therefore, we shall have this as 70,000. So when we add this, we shall have 135,000. So we take our total assets. So our total assets, the value will be 260,000. So this is the value that we have as our total assets. This is the value we have as our total assets. Then we go to equity, liability and equity. Equity and liabilities. So when we get to this, of course, now we shall start with the capitals. So when terms of the capital, we shall say capital. Remember, we have Brian. Now remember the balance we brought down from the capital account is the balance that we're going to show here, and the balance was 105,000. That was for Brian. Then we had Eunice, and the balance for Eunice was 85,000. That's the balance that we had for Eunice. So the next value we had, Robert, and of course the amount that helped Robert was 55,000. So this will be giving us a total of 245,000. This is it. So we had our current liabilities. Our current liabilities. Remember, we had our creditors. So we come here and say creditors. So they term them as payables. And they are worth how much? They are worth 15,000. So when you add this, actually you have your 260,000 as the total value. So meaning the statement of financial position has duly balanced. We have got the same figure. So that means that, of course, we have entered our figures right. So this is how we're supposed to compute, but this is the very first scenario. Remember the scenario I told that where goodwill is maintained in the books. So meaning that when you check in our books, actually goodwill will be there. Then I'm going to take the next question in my next video. I'm going to take a next question where goodwill is not maintained in the books, and we shall see how it flows. We shall see that actually even the value here, the two values will change, that they will be the same, but they will change in their amount because we shall have written off goodwill. We shall not have goodwill in our books. So this is all about the first scenario. So let me wrap up this. I'm going to come back with the next question in my next video. So thank you so much for watching. This is Kevin Davis Accounting.